So now we'll pass over to the next speaker, Dr. Amil Dasgupta. Are you ready, Amil? Yes, great. So
thank you.
Amil is a professor. Yes, Amil is a professor of finance at the LSE, where his research specializes on corporate governance. He's a leading expert in the field, has published in many of the top journals in this area. And he is actually now currently leading a sort of a master project funded by the UK Research and Innovation Agency on exactly looking at how stakeholders affect corporate governance. So he'll be talking about this topic for us now. Amil.
Great, thank you, Kevin. And it's a real pleasure to be speaking to you here at this NISM SRC conference. The only thing better would have been if we could have been doing this in Mumbai. You know, I normally miss the Indian cities, having grown up in one, but during this pandemic, it's been even worse. So let's hope for the future for gathering in India. Now, I'm going to try and share my slides. Okay. Are you all okay? You can hear me, you can see my slides now? Perfect. Okay, so yes. As Kevin mentioned, this is my talk is based upon sort of research that I've done for the past decade or so, really, time flies, on the role of institutional investors. In particular, at the moment, I'm sort of about halfway through a set of years when I'm running a large publicly funded research program here at the LSE on the role of institutional investors in corporate governance. And I'm going to be basing my talk on a very non-technical synthesis of 3 of my papers, which are funded by this program. So I acknowledge the input of the EQRI into this. And of course, then I'll be focusing a little bit on what these papers in particular have to say about what I perceive to be the state of play in India on these topics. Okay, so let me go back right to foundations to get started, which is to come up first with a working definition of what the role of shareholders in corporate governance is. What is the stewardship role of shareholders? So, and I'm just going to have this working definition for the talk, which is that obviously boards and executive compensation work perfectly in making companies work well. Then shareholders don't have an obvious role, but as long as that's imperfect and everything that we know from the academic literature and from the real world suggests that it is, then it is the idea is that shareholders can take actions that ensure the decision makers in firms, typically managers in the US and the UK and Anglo-Saxon systems, but also, for example, in the Indian context, promoters, controlling shareholders in a number of jurisdictions, act in the best interest of the full set of the firm's shareholders or stakeholders. Okay, exactly whether it's shareholders and stakeholders depends on the legal jurisdiction, etc. Okay, so what are the methods available for these actions? So one is what's collectively referred to as the use of voice. So this is the idea that shareholders can engage with management or promoters in behind-the-scenes discussions on things that could be done better. They could then place shareholder proposals on the proxy ballot of the firm at the annual general meetings, or they could indeed, in some jurisdictions, they can also run their own proxy solicitation process and launch proxy fights, for example, to replace the board. So, an increasing order of aggression, behind the scenes negotiation, shareholder proposals, and proxy fights. So that's one set, and that's referred to as shareholder voice. The other type of action is actually, in many senses, much more subtle, which is governance actions through trading. So the idea is that shareholders trade if they're unhappy with how the firm is acting, how the promoters or the managers are behaving. They can sell their shares and move on. And of course, concerted sales by shareholders will lower the share price, which of course is bad not just for managers but also for big blockholders and firms like promoters. And so these sales will lower the price, which will then make these decision makers in firms effectively pay more heed to what these shareholders are doing. Okay, so those are the sets of actions. So in some sense, if you think about the corporate governance literature in finance, the picture that is typically considered here is that there's somebody who's holding a block of shares, the equity block holder, and there's somebody who's making decisions in firms, whether that be the manager in the US system or a promoter in some of the jurisdictions. Okay, and these guys are meant to monitor these guys, and the monitoring actions that they can take are these actions through voice and exit that I've just been outlining. Okay, all right. So that's the background. So now let's think about what's been going on in the past 70 years. Now, some changes. Ajit was talking about the rise of fintech and algorithms and so on happen in sort of 50 months, and so they're very visible. Other changes are just as big, but they happen in 50 years, and they're sometimes not as visible, but they're no less fundamental. So one of the biggest changes that's happened in financial markets around the world in the past 50 to 70 years is the rise of intermediation. So if you look back at the 1950s and 1970s, this is numbers for the US. This is drawn from one of my papers, which is actually a very broad review of this area for non-technical audiences. So if you're interested in this area, this is a good paper to sort of get an overview. If you look at the 1950s and 1970s, in the US, for example, if you looked at the household sector, most shares were owned directly by households, right? We're talking about rich, high net worth households. If you look, 50 to 70 years later, the picture looks very different. Households no longer directly own much equity. So what's happened to the ownership? Well, the complement is what we call institutional investors. So if you think about pension funds, both private and state, mutual funds, exchange traded funds, etc., these had a very limited role in the 1950s, 1970s, but they have taken over the vast majority of the market in current times. Okay, so there's a huge shift in the ownership of equity. In the US, it's very marked, and we have very detailed data. So I've shown you the US first, but this is actually a global phenomenon. So again, in our paper, we document what's happened, for example, in the next 5 largest economies, which includes India. And here's what you see here. And India, so you can see the UK is this line over here, very prominent in terms of institutional ownership. In India, the green line. Again, if you look between 2005 and 2017, institutional ownership, mutual fund, hedge fund, alternative investment funds, ETFs, etc., they've doubled. Okay, so we're using FactSet data because FactSet data is very comparable across different parts, different countries. But there are multiple data sources in this. And the levels are sometimes somewhat different in the measurement. So, for example, the IIS, the proxy advisory firm in India, had a presentation looking at corporate ownership, and they argue, based on a different data set, that in March 2019, as much as 1/3 of corporate shares in India were actually owned by institutional investors. So in some sense, the picture is towards very stringent growth in intermediation in the growth of institutional investors in India as well. Okay, so then really we sort of have to modify our picture, right? So remember, this was the picture that we had in mind before, but this is not really the picture anymore. The picture is actually one of 2 sets of monitoring relationships, the old one and the new one, because the block holders, who are institutional investors, are actually holding blocks in these companies with other people's money. Okay, so just as the equity block holder is monitoring the decision maker inside the firm, the people who fund the equity block holders, the fund's investors, and notice that the fund's investors don't have to just be private individuals. They can also be, there's often chains of intermediation. So you give your money to a pension fund, and the pension fund then hires a mutual fund, et cetera, et cetera. So there's often, this is a proxy for actually possibly multiple monitoring relationships. But certainly there is multiple layers in the monitoring relationship. Okay, that's sort of definitional here. And so just as these guys may take actions, the block holders may take actions, voice, exit, etc., in order to influence the running of firms, so might the fund investors. And what sort of actions might they take? Well, fund investors, in some sense, have really only two options. If they're happy with how the fund is doing, they'll leave their money in the fund, or even put in more capital into the fund. And if they're unhappy, they'll take their money out of the fund and they'll give it to someone else. Okay, and so this is kind of the definitional issue that governs the new corporate governance landscape with regard to institutional investors, which is the monitoring is multi-layered. Okay, and this is two key implications that we should keep in mind that is going to be useful throughout my talk. I almost surely will not take my full half an hour. So since I stand between you and lunch in the UK and you and tea in India, yeah, I can reassure you that this won't go on for very long. So this multi-layered monitoring mechanism has these two implications. One is that, look, institutional investors, these guys, the people in the middle, have to choose all their actions, I'd argue essentially all their actions, including stewardship, with an eye to keeping their clients happy. Well, their clients, the people who give them capital. Essentially, the idea is that you can't be a money manager unless you have money to manage. Okay, it's as simple as that. In finance jargon, institutional investors are people who compete for flow. So they compete for the flow of capital into their funds. It's often, to some extent, a reallocation process. Funds, capital flows from underperforming funds to overperforming funds. Okay. All right. So that's implication one. And the second is, because institutional investors are managing the money of other investors, often at the end, retail investors, governments have the ability to regulate them in a way that places positive obligations on them. Okay. Now, this is something lawyers care quite a lot about, and I think it really matters, okay, which is that if I'm a private individual and I'm investing in equity, laws can prevent me from doing certain things, okay, but they will typically not be able to place positive obligations on me to do particular things. But if I'm managing somebody else's money, and that person is typically a retail investor, then the law can place lots of positive obligations on me to do things. For example, the obligation to vote, to report voting policies, to engage or monitor companies, etc. Okay, this is often done in many countries, including India. It's done through a corporate governance code. Okay, for institutional investors. So these are the two things. So one, institutional investors care about having money to manage, and regulators can place positive obligations on institutional investors that they cannot on non-institutional investors. So if you put these two things together, we just need to marry these two things in some sense to really think about the question in detail, which is, can one design the regulations on institutional investors in a way that recognizes their most fundamental incentive, which is having money to manage? Okay, so that's going to be the central thesis of the rest of the talk. But let me, before I get into the detail of a couple of my papers, I'm never going to get into the detail, but before I tell you a couple of the mechanisms that emerge from my papers, let me just briefly outline the Indian context as I see it. And of course, there are many lawyers and regulators here on the panel and in the audience who may know more about me than this. And please do feel free to correct me if I've got some of the fine aspects of this not completely correct. So as I read the set of commentary on India and institutional investors, I come across three different challenges that are highlighted. Okay, one is purely a regulatory challenge, which is that I've seen this highlighted multiple times, that there's a multiplicity of codes of behavior for institutional investors. So for example, in 2017, the IRDAI had a code for insurance companies. In 2018, the PFRDA had a code for pension funds. And of course, SEBI has the 2019 code for mutual funds and alternative investment funds, which came into force, I believe, sometime the summer of 2020. So it's quite recent. So people lament, in some sense, the heterogeneity of coding. Okay, so I'm just outlining the challenges that people talk about. I will give you my own thoughts on these shortly. The other thing is that relative to certain, say, the US or the UK, the 2013 Companies Act of India, okay, places a somewhat broader remit on corporations, on companies, in terms of stakeholder representation, stakeholder orientation, CSR, as opposed to just shareholder value maximization. So I read commentators talking about how this makes the role of institutional investors sort of less relevant, perhaps, for the Indian corporate governance landscape. And then, of course, there's the key thing in India, which is that there is a much larger presence of sponsors, a dominant role of controlling shareholders or founding shareholders. That must also be taken into account. So let me tell you my views on this, because this is in the wide debate. So looked at it from my perspective, I'm well more optimistic than some of the debate that I read. So if you think about sort of the multiple coding issue, it's not clear to me that while there is a lot of action in the space of introducing uniformity into the coding. So Dr. Nair's talk yesterday referred to some of this uniformity, and there are many benefits to uniform coding, but fragmentation of coding by itself inherently is not particularly a problem. I'll tell you why. You just have to look at the US. In the US, private pension funds are regulated by ERISA. State mutual funds and hedge funds, to the extent that they haven't arbitrarily the regulation, are regulated by the Investment Companies Act. And state pension funds are regulated by state law. And there is no unifying mechanism at all. And as far as I can tell, corporate governance through institutional investors is alive and well in the US. Okay, so in some sense, I don't see fragmentation as a critical problem. Of course, there are benefits to unified coding, but fragmentation is not a critical problem. The broader legal remit on stakeholder orientation for UK for Indian firms, I can sort of see how, maybe 10 years ago that was could have been an issue, but as the institutional investing population globally starts to move towards, ESG mandates very widely, I think that there's much more alignment now between the broader remit set out in the Companies Act of India in 2013 and the orientation of many of these institutional investors anyway. So I think that problem was certainly there, perhaps in the past, but I think it is getting less of an issue now. I think the key issue, and this is what the rest of my talk is going to deal with, is the dominant role of controlling shareholders. This is clearly the case. Now, there is a good reason to believe that, especially for the larger companies, the role of sponsors is getting less prominent in India, but it is still the case that relative to the US and the UK, shareholding is more concentrated in the hands of sponsors. Okay, this then points to an opportunity as opposed to a problem, as far as I can see, which is that it points to a direction where regulation can go, which is what we really need from institutional investors, is coordinated engagement. Why coordinated engagement? Because in the presence of large controlling blocks, the only way to have meaningful influence for a large number of relatively small blocks held by institutional investors is to act together, to act in concert. Okay. Interestingly, while I'm making this academic point, the SEBI's 2019 code explicitly recognizes this issue. So, for example, Principle 4 will impose on institutional investors the requirement to have a clear policy for collaboration with other institutional investors where required. Okay, so this is very laudable. What I want to talk to you about in the remaining minutes of my talk is what I think is the need to incentivize coordination as opposed to encourage or mandate it. And I want to explain to you why it's necessary to incentivize it, and then talk to you about two different ways in which SEBI could think about incentivizing it. Okay, so what is the problem with coordinated engagement? What is the sort of fundamental obstacle that has to be overcome in order to get coordinated engagement? The issue is that engagement is costly. Okay, so resources are limited. Institutions hold many blocks to go and talk to companies, to go and promote, to put shareholder proposals, or to do something really aggressive like launch a proxy fight. This is costly. It's costly not just in terms of manpower. It's also costly in terms of ruining relationships, perhaps with corporate managers, affecting your reputation amongst them. It's also costly in many jurisdictions in terms of legal risk. Companies can sue you for partial declaration and things like that. It's very true in the US. To differing extents, true elsewhere. While it's costly, it's very easy for shareholders to free ride on the efforts of other shareholders in terms of engagement. Because you see, if others engage and generate value enhancement in terms of, say, a share price appreciation, those that don't engage, well, they still hold the shares, they still get the benefits. Okay, this is the key thing, which is that the people who engage get the costs, but everyone who holds shares get the benefit. Okay, which then creates an incentive to free ride on others. This is in technical terms called engagement is a public good. Think about the tragedy of the commons, right? The individual blockholders' incentives to engage are low relative to the overall social and company benefits of engagement, okay? Which is where we have an externality, and whenever you have an externality is where we then have a role for regulation, okay? So in some sense, while the current code, and this is true of other codes elsewhere in the world as well, encourage or even mandate coordination, I would like to see a movement towards regulation that sort of pivots on the incentives of institutional investors to make it in their own interest to engage. Because of course, encouragement can be ignored, and mandation, this is a perennial source of disagreement between economists and lawyers. You can mandate whatever you like, but if enforcement is costly, it's very hard to achieve much by mandation. Okay, all right. So what I'm going to do in the remainder of my talk is that appreciating institutional incentives to compete for flow is we might be able to pivot on that fundamental incentive in order to tweak regulation in ways that make a coordinated engagement more effective. And I'm going to do this in two ways in just 2 slides before I conclude. Both very non-technical summaries of a couple of my recent papers. One is going to deal with coordinating shareholder voice. So all these actions like behind the scenes engagement, voting, etc. This is based upon a paper called Wolfpack Activism. It has this rather odd name because the motivating example is activist hedge funds in the US and the UK leading joint engagement efforts. This is forthcoming in Management Science, but again, the pre-publication version, which is essentially identical, is available for free on my SSRN page. Now, this is a theoretical model. Let me just summarize it for you very, very briefly. This is the idea is that institutional investors who are asset managers, they're funds, they have differing skills for identifying or participating in shareholder engagement. Okay, so some companies are easier to change, are easier to achieve good outcomes in. Other companies, it's doomed to failure. Some of these guys are better at identifying the good opportunities than others. Okay, and of course, if you're an investor, you want to be with the skilled funds. So you want to identify the funds that know what they're doing, and you want to keep your capital with them. If you find that there are some funds that don't know what they're doing, you want to take your capital from them and give it to someone who knows what they're doing, okay? And then the usual free riding problem arises, which is that shareholder engagement is costly, but benefits not just the engagers, but also the people who don't pay the cost of engagement, okay? So again, in economics, we say that whenever there's an externality like this, the solution is that if there was a government, the government would step in and it would penalize the people who were not providing the public good, and it would reward the people who were providing the public good. Okay, in this case, engagement. Interestingly, flow incentives, competition for flow, actually acts as a mechanism for making exactly this happen. Because of course, investor capital flows from unskilled non-engagers, or the unskilled failed engagers, to skilled engagers following successful engagements. So when there's a successful engagement, the funds that know what they're doing will be in there, and the funds that don't know what they're doing won't be in there. And if this is visible to investors, then of course capital will reallocate. The reallocation of capital rewards the people who paid the cost for engagement, and it penalizes in the same breath, because of course it's coming from the funds that chose not to engage. So effectively, the flow mechanism can reduce the externality by rewarding those who pay the cost of engagement at the expense of those who don't. Okay, now let's step back from this. This is my theoretical model. What are the regulatory considerations that flow from this? Okay, well, what you want to have is a situation in which the funds, the investors in these funds can observe what's going on and move their capital from unskilled to skilled funds. What this requires is making fund by fund information on engagement efforts available in some sort of comparable form. I've underlined comparable form on a regular basis. Why have I underlined comparable form? Because if you look at the SEBI code, for example, for mutual funds and AFIs, you see that the SEBI code does encourage them, does mandate that they should publish their voting outcomes, their votes cast, but it also leaves them with quite a lot of choice in terms of the frequency and the manner of this reporting. Whereas for investors, perhaps what's most beneficial is that you should be able to see comparative things. So in some sense, you should be able to see them at a similar frequency and in a comparable manner. The other thing that struck me looking at the Indian picture is that proxy access. So if you look at the 6 largest economies in the US, in the world, so the US, UK, Germany, China, Japan, India, you have proxy access rules, how easy it is for the shareholder to actually place proxy proposals on the company's balance, on the company's annual general meetings. India has the highest threshold for this, 10% ownership, if I understand it correctly. Dr. Nair can correct me if I'm wrong. That compares to a much lower threshold in some other countries. So that might be worth considering. Okay, so easing proxy access and making comparability possible across institutional investors would be helpful. Okay. The second mechanism that I want to point out, which has different implications for regulatory intervention, relates to the exit governance mechanism, so governance through trade. Okay, and this is a relatively new paper, so I'm citing it as a working paper. It is, however, quite close at the very last stages of consideration at one of the leading finance journals, and so I hope to be able to refer to it as the published paper soon. So this paper, on the other hand, has both theoretical analysis and has supporting empirical evidence, and so it has direct real-world implications. And again, the mechanism is this competition for flow, the need to be able to have capital to manage. So there is there are differences between institutional investors in terms of how exposed they are to outflows from their investors. So if you think about a hedge fund or a pension fund, they typically experience far slower outflows. In the case of hedge funds, because they have lockups. In the case of pension funds, because pension investments are made on a 30, 40-year horizon. But mutual funds are discretionary capital. People take their money in and out of mutual funds all the time. So mutual funds will be more exposed to outflows. Okay. Now, if you think about an institutional investor who is more exposed to outflows, they're going to be exactly the people who are going to not want to be left holding the hot potato in some sense. So if there's an engaged blockholder who knows quite a lot about the firm, who sells out of the firm because they become dissatisfied with how management is doing and how management is responding to encouragement to do things differently. And when I say management, I mean either managers or sponsors. Then the flow motivated investors like mutual funds will be the most concerned about holding on to those shares, and they may be tempted to sell as well, just to not look bad, not look at like the people who are holding on to the underperforming shares. Okay, but what this does is that if there are lots of these flow motivated investors around, then the exit of an engaged blockholder is then piled onto by lots of other shareholders, leading to a much larger sale, correlated sales, leading to a much larger price drop, which means in turn that the decision makers and corporations should take the voice of the engaged shareholders more seriously. Okay, is this just a theoretical model? Not really. So if you look at large sample evidence from the exits of US activist hedge funds over a 15-year period, we find very persuasive evidence that mutual funds end up selling out significantly more than other institutional investors in following these exits. What is the regulatory consideration out of this? So I guess what you want to be encouraging here is a sort of implicit coordination that comes through trade, is you want to be able to make precise and timely information available by the trades of engaged blockholders to other market participants. Okay, and there is indeed law in most jurisdictions, including in India, that reflects this. Everyone who crosses the 5% ownership threshold has to report changes in ownership, sales, for example, that amount to 2% of the overall shareholding in the company. Overall a set of shares in the company or higher. Okay. Now, while that is effective, it still allows quite a lot of these sales to be quite private, because it allows you to sell up to, if you're a 5% blockholder, 2% of the company is 10% of your holding. So in some sense, it's not clear that the revelation is going to be very immediate. So one thing that one could consider is bringing this regulation more into line, for example, with what happens in the US, where any changes in shares holdings by 5% or larger blockholders will be reported. The other side of the coin is that these engaged blockholders should also understand who the other blockholders are. And so any efforts by regulators to make the share register of the company visible to engaged blockholders would again help this level of coordination. Okay, so just to wrap up, the holdings of institutional investors is a big deal. They're increasing everywhere in the world. They're increasing in India. Okay, so in order to make corporate governance work effectively, it's important to involve institutional investors in stewardship activities. And everywhere in the world, but particularly so in India with the presence of sponsor shareholders, of promoters, I'm sorry, it's key to coordinate the engagement activities of these institutional shareholders. And I would argue that over and above encouraging or mandating it with governance codes, it would be interesting and productive, presumably, to pivot specific aspects of the regulation and revelation on reporting to essentially pivot that on the key incentive of institutional investors, which is to compete for investor capital, by doing that, I think we can potentially reboot financial regulation in this area even more. Of course, it's very hard to discuss all the details of regulatory prospects in a public forum, but anyone who's interested in this, I'm very happy to have follow-up discussions on it. I'll wrap up now, but very happy to take any questions that may come up. Thank you.
Thank you very much, Amil, for that fascinating talk. So if people have questions, they can sort of type them into the Q&A box, or panelists can just ask the questions directly themselves, if you guys can unmute yourselves. But we have one question from the audience so far, Krishna Murthy. So in situations like the current one, where there is an excess flow of money into equity funds, how should institutional investors trade off between well-governed companies versus return to their investors? Or is there a trade-off there?
Let me see. So I think that this is an important issue, Krishnamurti. That there is a debate. The activist hedge funds have been participating quite actively in this issue of how should investors be. Should companies be retaining cash for long-term investments or returning to investors? And activist hedge funds have typically been on the side of returning cash to investors. Now, it's important to understand, I actually talked to my corporate finance students at LSE about this, that the incentives that drive this, a lot of this is driven by taxation incentives, because activist hedge funds typically have clients who are like, sovereign wealth funds or endowments or pension funds, all of whom are tax-free, whereas the companies, when they retain cash, are actually paying out large corporate tax bills on their investments, on their financial investments. And so these guys are often making a very sort of privately optimal argument in some sense, where they're saying, just pay out the cash to our investors because of the tax exemption that they all have. This is not necessarily good for companies. So activist investors have been quite effective in enhancing corporate value, but there is also evidence that excessive cash returns can be problematic in terms of the credit rating of these companies, and so this is a pretty nuanced point. But in some sense, where I would slightly differ from where you're going with this question is that I don't think it is necessarily the excess flow of capital into equity funds that's driving this phenomenon in some sense. So there you're sort of describing what's happening typically in retail funds, whereas the payout policies of these companies are typically driven by more of these activist hedge fund type of investors. So I think those are slightly two separate issues. Thank you.
So I have a question I have to ask. So you're talking about sort of mostly active funds here. But how do you think the rise of passive funds will affect these dynamics that you discussed in your paper?
So passive funds, so it's a slightly subtle issue. So it is true that passive funds don't compete for capital on a returns basis. So the best passive funds in principle should just be a fund that replicates the index. That said, passive funds are part of fund management companies, okay? And those fund management companies have different engagement profiles, and direct engagement is progressively important to investors, okay? So in some sense, it's quite possible that these passive funds may also suffer from the movements of investors across different fund management companies, families of fund managers. So that's one thing I would say. And the second thing is that passive funds also vote, by the way. And so in some sense, the regular and transparent reporting of voting of passive funds that makes it more comparable to others may still be valuable. Okay, so the one thing that passive funds cannot do is participate in the second governance mechanism that I suggested, because that is all related to trade, and of course, passive funds by definition don't trade, right? So, but they still play a role in the first mechanism. More generally, sort of, the debate about whether passive funds are good or bad for the economy, you referred to it briefly in your comments yesterday. I think that the jury is extremely out on that. I mean, it's just, there have been many academic papers that have started to deal with this issue, but I think that it's quite early in the game, and it's clearly good for investors because active funds after fees have not been known to perform so well relative to passive funds. But the global impacts on corporate governance, on the informativeness of pricing and so on, I personally think the jury is still out on that.
Thank you. So are there any other, see if I'm missing any questions here? Are there any questions from the panel or on these topics? Okay, well, excellent. Then thank you very much, Amil. So, and we will, I'm sure that people will take you up on your offer to follow up in more detail separately or directly through your email contact.
Thank you very much.
So, thank you very much. All right. So that brings our conference to a close. So let me, so thank you all very much for participating. So let me pass over to John Danielson, the co-director of the Systemic Risk Center, for some brief closing remarks, and then to Dr. Latha Jari.
Thank you very much, Kevin. Thank you very much, Kevin. Good afternoon, everybody. So on behalf of the Systemic Risk Center and the London School of Economics, I do want to thank you all for attending what I think was an excellent conference. I came to it yesterday with high expectations, and I am happy to say that my expectations were exceeded. The presenters and the discussion was absolutely first-rate. This conference is the first event in a partnership between us and SEBI NISM, and we do have ambitious plans for the future, hopefully to echo Amil's wish at the start of his talk, in person, either in India or in London. I do especially want to thank the Dean Narasham and SEBI's Chairman Tyagi for supporting this event. The organization of the plan by Kevin and Julius on our side, and Latha and Venat on the Indian side was absolutely first-rate. But the biggest thanks go to our absolutely excellent administrative team on our side, Anne and Oana, and on the Indian side, Vashim, Babishav, and Aroshash from SEBI. And with that, I declare the conference closed, and may you all have a pleasant afternoon.
Thank you very much, John. And Latha, would you like to say a few words, and then we'll be finished.
Thank you very much. We would like to thank all the participants, the speakers, the chairs who have made this conference an excellent success. We would like to thank our director, Dr. CKG Nair, our dean, Dr. V.R. Narasimhan, of course, Dr. Kevin, Dr. John Danielson, Mr. Zeppi. We had an initial meeting with a few months ago, and it has been a successful experience for both the institutions. We look forward to collaborating on more such programs in the months to come. So we would like to thank on behalf of the NISM team. Thank you very much.
Excellent. So as both John and Latha have said, watch this space. Okay, so good. So thank you all very much. And I said I very much enjoyed it. So hope you guys benefited, and we'll see you again. Goodbye.